All right, I got the thumbs up from Will, so we can get started. My name is Mark Lamonica. I'm the product manager for Morningstar Premium, morningstar.com.au. So coming to you from rainy Sydney. So hope everyone is doing okay with the weather. All right, so we'll go through our housekeeping items first. So number one, anything you hear today is general advice. So I don't know anything about you. I can't offer personal advice. But I would like a lot of questions because it makes it more entertaining for me. And that's what we're here for, right? So please ask as many questions as possible. So just, you can throw them in the chat or throw them into the comment section. And yeah, that will hopefully make this, well, definitely make it more interactive, but hopefully more fun. So today is an interesting day. So for those of you that don't remember the 23rd of March last year, this is the day that the ASX hit its 2020 low. So if we remember what was happening last year, we were just about to enter, at least in New South Wales, COVID restrictions. The market had been falling since mid-February. So it seems like a good time to look back across the year and kind of see what happened and how that, of course, informs where we're going from, or where we are going, or where we may go, since we can't predict the future, from today. So let's get into this. So I titled this, The Pandemic 1 Year Later. Very creative title, but that's me. Okay, so as I said, let's look at some market returns. So very easily, I just went in there and clicked on 1 year because we're going back 1 year. So first, we are looking at the ASX 200 as represented by the Vanguard Australian Shares ETF. And you can see in the course of a year, it's up around 41%. So pretty good. Very good. And for those of you that were premium subscribers, I think 3 days before today, Peter Warren said you should put some cash to use in the market. So pretty good call by Peter. All right, let's turn our attention overseas. Let's look at the S&P 500. So this is represented by an iShares product, ticker symbol IVV. And you can see the S&P 500 is up 22.6% over the course of the year. Now, you're probably thinking, that doesn't sound like a lot. We keep hearing how great the US market is doing, and that is because this is unhedged, and this is a little preview for what we're going to do on Thursday, where we talk about international investing. Unhedged means, of course, that currency comes into play. So let's look at the S&P 500, another iShares product, so ticker symbol IHVV, which is the exact same ETF, following the exact same index, but this one is hedged, which means that you do not get the impact of changes in the value of the Australian dollar, with, in this case, the US dollar, up close to 60%. So that 28% difference represents loss that you get basically because the Aussie dollar has done really well against the US dollar over the course of this year. So if we remember another thing that was happening back last year, the Aussie dollar fell into the mid-50s against the US dollar because everyone was worried about China and worried that demand for commodities, iron ore, et cetera, that's exported out of Australia was going to sink the local economy. But that actually held up pretty well. But anyway, people were really worried about that. And as it became obvious that China did very well compared to a lot of other countries, including the US in the pandemic, the Aussie dollar, of course, started going up. And that is a pretty dramatic difference, right? 28% in return. So 28%, the difference is actually more than the return you would get if you were in the unhedged S&P 500. So I'm going the wrong way, which pretty much symbolizes my day. Let's talk about valuation. So we looked at, of course, looked at how markets had performed, but let's look at valuation. So I went on to our Monitor Markets page and I grabbed our price to fair value for all the different markets that Morningstar analysts cover stocks. So of course you can see a lot on here. And what price to fair value represents is our analysts' rolled up view of the underlying market. So In Australia, we cover a number of companies. What we're doing is we're basically rolling up those individual company views that each one of our analysts calculates. So they calculate a fair value, what they think the share is worth. They compare that fair value to the price, where we get a price to fair value. So anything above 1 we think is overvalued. Anything that equals 1 we think is completely fairly valued. Anything below 1 we think is undervalued. So let's look at what's happened today versus a year ago. So I'm obviously not going to go through all of these, but you can see in almost every case, actually probably every case, the 1 year ago price to fair value is significantly lower. So let's take Australia as an example. So today we think the Aussie market represented by the companies that we cover, and we are taking an equal weighted view of those when we roll those up. We believe it's 8% overvalued. So that's what 1.08 represents. 8% over 1. So we think it's 8% overvalued. If we went back a year, we thought it was 24% undervalued. So a pretty wide swing that it's taken, and you can go around and look at all the different markets if you'd like. And in terms of markets that are actually undervalued, that we still think are undervalued, you can see a couple of them in Europe. So that is a valuation level. So we wanted to talk about a couple different, we have a question already, which is good. All right, the question is, how can I find the valuation levels on the website? I can do that. Okay, so we'll answer things as they go along. All right, so where do you go? You go to monitor markets, as I said. There's Australia. That's the box I copied. You can go through each one of these. Oh, I'm not sharing that, am I? Oh, no, I am sharing that. Look at that. Did something right. So you can go through each one of the continents and find the different valuation levels. So those are the boxes that I copied in. So thank you for that question. That was good. That was like our earliest question ever. All right. So talked about valuation levels. Now we want to look at what has actually been the impact of this, of what's happened over the past year, because while we can look at overall valuation levels, while we can see markets have gone up, what has gone up and the different sectors that have performed well, both overseas, which we'll take a look at, and here in Australia, vary pretty widely. So let's look at one thing that has done extremely well. Let's look at US technology shares. So anyone who's tuned into some of these previous ones, we did a whole webinar and a podcast on tech shares and how well they've done. So a couple things to think about, and we've heard this a lot. Obviously, what I'm saying is not exactly profound, but we've heard a lot of trends that were occurring were, of course, accelerated with COVID. And a lot of those trends are around technology. So the obvious one, of course, is work from home. So anyone who's tuned in to these things for a while now remembers when we were doing them a year ago, it was Will and I in the office by ourselves. Now they let everyone else come back, which is really cramping our style, right, Will? We have to deal with all these other people, but work from home. So we've certainly seen this. So if you look at the U.S., 45% of U.S. workers said they worked from home in 2020, compared to 9% in 2019. And what this, of course, has benefited is a lot of the technology companies that supported that. The other thing, of course, that has really been has really benefited the companies, we'll get into this in Australia in a little bit, is, of course, entertainment at home. So certainly Netflix has done well, things of that nature. And, if we look at the Morningstar US Technology Index, so that's basically just a sector view of what has happened. So it was up 47.5% in 2020, which is pretty significant. So technology is certainly one place that has benefited a lot. The other thing we want to look at is communication services, and once again, you can see these charts. So just to explain these charts, obviously undervalued, you can see significantly undervalued. going into the pandemic, now kind of bouncing around, fairly valued. So what is communication services? Well, it means a lot of different things. And of course, the telecoms are in that. But the other things that are in that are Facebook and Google. And we'll talk a little bit more about their influence in the US markets. But Facebook and Google both were hit pretty hard early in the pandemic. And the reason for that is one of the things that people generally do, one of the things that companies generally do when they're responding to a recession is they cut back on advertising because it's easy. Very, very easy to cut back on advertising. That is something that is an immediate cut that you can make rather than laying people off and things like that. So there was a lot of fear that platforms like Facebook and Twitter and Google, all companies that rely heavily on advertising, would fall off, and all of them came roaring back. And basically because all of a sudden now we have a bunch of people that are shopping, and we'll get into retail in Australia, that have been shopping from their homes, where it's obviously advantageous to advertise to them through the internet. So that is certainly what has occurred in communication services. So a couple other things that are happening. Of course, we see kind of this dip this year. So there are, and this is right around, if you remember, that's right around when Trump got banned from Twitter, and there were concerns about increased regulatory scrutiny of some of these companies. All right, moving on. We're moving quickly, which means maybe I'll be able to go get a soda before my next meeting, which is exciting for me. Energy. Okay, so the other thing that happened, and this happens in any recession, but the other thing that happened is, and we'll spend some time looking at Australian energy providers in a second, is that energy plunged. So 2020, the energy sector in the US, and similar here in Australia, was down 33%. So if you think about how much energy was down compared to those market returns, so the overall US market, and remember we were looking at a figure from the low in March up until today, but if you look over 2020, the overall US market was up just north of 20%. Energy sector was down 33%. And this is obvious. So anytime you go into a recession, demand for energy falls pretty significantly. That was especially true in this recession because, once again, people are staying home. So they're not traveling, so that sort of knocks out the airlines. They're not driving as much because there's nowhere to go. So there was a pretty big additional demand drop for oil. I will say that energy is one of our favorite sectors here in Morningstar. Now, maybe not long-term. So I think long-term, we certainly recognize everything else that's happening in the market. We are switching more to more fuel-efficient vehicles or perhaps completely electric vehicles. But we do believe that demand for energy will return to quote-unquote normal. And we'll get into that a little bit with Australia. So normal will, of course, be the same situation when over the long term, we do expect a continued decline in energy. But we think for the short term, as economies start revving back up, that we will see oil demand go back to normal and some of the other energy plays as well. One thing is, and what our analysts have come out and looked at, Tesla obviously has done very, very well this year. There is clearly a trend to move into electrical vehicles, but we don't think that will make a dent in petrol demand for the next decade. So our energy analyst said that today, still the majority of cars that are purchased are not electric, and the average car on the road, and this is a US figure, but similar here, have an average life of 15 years or more. So energy is something we see very, very undervalued. We'll get into some names in Australia. All right, so that's looking at some of the sectors where we saw big moves over the course of the year, some of them negative, some of them positive, but let's get closer to home and look at a couple different things that happened here. And we're gonna look at two sectors here, and we're gonna look at some specific names in these sectors. So we're first gonna look at retail. So retail, as people remember, did really well. And retail did well for a couple different reasons. So number one, retail did well. If we sit there and look at some of these names, certainly Kohl's and Woolies, the supermarkets did very well. Now, the supermarkets did well because there's nowhere else we could go. We all remember, of course, everybody going out and hoarding food and toilet paper and other supplies. Both these stocks, Kohl's and Woolies, did well this year. We think they are very overvalued. So just so people are aware, from a star rating perspective, so that's really looking at 5-star stocks are the ones that's the biggest discount between fair value and where a stock is trading. A 1-star stock is the most overvalued stock. So if we look at Kohl's and Woolies, 22% overvalued for Kohl's, 37% overvalued for Woolies. You're seeing very high price to earnings ratios, et cetera, for all of these stocks. So that's one thing. And our analyst, Johannes Fall, who covers retail, believes that any bump in sales that happened not only with Kohl's and Woolies, but also a lot of the other retail spending that occurred in 2020 will go away. So I think sort of across the board, we are going to see a return to normal. So we see a lot of this. Harvey Norman, everyone decided, and once again, there were certainly people that did lose their jobs and that were affected by this recession, but generally most white collar workers did okay and had huge increases in savings, and a lot of that has come through in consumption. So whether it's people going out and buying new TVs, et cetera, we do think a lot of the investor reactions to these stocks have been way too positive considering some of the long-term trends. And then of course you see things that did not do well, such as Myers, but we believe that, once again, in terms of accelerating this pandemic, accelerating trends that were already happening, is accelerating the trend into more and more online purchasing. And we saw that with the way that Amazon performed. And we've kind of seen it across the board where a lot of companies have shifted more of their focus to online and shrunk their base of stores. So we've seen that as well. So once again, we think retail overall is very overvalued, and it has been certainly a safe haven from both how a company has performed, but also from an investor perspective over the course of the year. But we think that's probably overblown. All right, so we'll get into some of the specifics. We're getting a couple of questions on specific securities, which we can get into in a second. But we wanted to look at energy. So we talked about energy. So just so everyone is aware, this is energy. I realize now that I did not update the slide, and it still says retail, but these are energy stocks. So I want to take this a little closer home. I talked about energy. You can see that across sort of the oil and gas and coal areas are some of the cheapest stocks that we still see. So when we do sit there and we talk about the Australian market being 8% overvalued, we start looking at some of these energy shares. You can see there's pretty significant discounts to fair value, particularly, and I think that one of the cheapest, or the two cheapest stocks that we have in Australia, or three cheapest, I think are Whitehaven, Z Energy or Z Energy, and Beach. So three of the cheapest stocks that we see out there, and you can see they are 5-star ratings. And one thing to note is that all of these have pretty high uncertainty ratings, just because they're clearly based on commodity prices. And yeah, there is certainly a worry about that, but we believe in many ways that a lot of those prices will return back to normal. So just some names on both the expensive end from a retail perspective, and then the cheaper end from an energy perspective. And we'll get into a couple more picks, our global best ideas, in a second. But I want to talk about a couple global themes that I thought would be good to speak about. So 3 things happen globally. Some of these apply to Australia, some don't as much, just given the makeup of the market. But 3 things I think investors need to be very wary of. And we're actually going to do a whole podcast episode kind of diving into these. So what we've seen since the GFC is we've seen a big shift into passive investing. So I believe the stats are that something like 45% of investing now in the US market is done passively. So those are people that are following an index. And it was about 25% coming out of the GFC. So in a little over a 10-year period, we've had a huge increase in passive. Now, what that can do is a couple different things. And once again, we'll spend more time exploring this in the podcast. But what it can do is it can really distort markets. And there is a fear. Some people fear this a lot. Some people think that this is overblown. But there is a fear that passive investing is going to distort equity markets. And the reason that it's going to distort equity markets is because if we think back to the whole point of passive investing and what a passive investor will tell you is that there is efficiency in the market. And that efficiency comes from millions of different participants who are trying to who believe the market's inefficient and believe there are opportunities to find cheaper stocks, which we believe here in Morningstar. And the price discovery that's occurring as they are trading and trying to find undervalued stocks, that is actually coming up with a consensus view of all those all those participants in the market that more accurately reflects the underlying value of securities. Now, the problem is, and this is why people want to invest passively, they say that most of these people out there picking individual shares are not very good at it. But they still serve this purpose of basically averaging out the views across the market that's reflected in a stock price. So what happens when you lose active investors? Well, you lose that price discovery. And a lot of the argument for using passive investing goes away. So that's something to think about from an intellectual standpoint. The other thing that passive investing does is that basically because we are investing into markets that are market cap weighted, what's happening when people invest passively and they are just plowing more money into these indexes, it means all the stocks that are doing really well continue to do well. So basically you get this momentum trade that's happening. And the simple way to think about this is we'll use one company as an example, and we can use Apple. So Apple makes up something like 6.7%. It's the world's largest company. It makes up something like 6.7% of the US S&P 500. Now, it became the world's most valuable company back in 2011. And don't have the numbers in front of me. It was worth something like $400 billion in 2011. It's worth $1.9 trillion now. And the P went up from 11.5, somewhere around 11.5 to 33 now. Now, maybe Apple is a company that has a lot brighter future now than it did back in 2011, but it was growing a lot faster in 2011. So that's just an example of as money, and we don't know the reason for this, right? We can't go in there and dissect every trade, but as more money gets pushed into passive, large companies, because they make up more of the index, large companies are getting bigger and bigger and bigger. So a couple different things happen. We have this increased concentration in large cap stocks. So that is certainly something that's happened in the market. We have increased concentration in certain sectors. So technology. So technology has grown to the second highest level that it's ever been, making up of the S&P 500 and global indexes. The only time it was more was back in 2000 when we were in the dot-com bubble. So we've had increased concentration in certain sectors. And then we've had the continued dominance of growth investing. And we did a webinar on this where we looked at growth versus value, but very simply, value, a study was done, this Fama and French 3-factor model study that went back and looked at historical data, and they were doing this in the 90s, and basically found that there are different factors that drive equity returns. One of those factors was value, that over time, value did better than growth. And if you go back and look at historically, the whole let's throw a dollar in the market in 1900 and see where we get, value has done better than growth over time. Now, since the GFC, that has been flipped on its head, and growth has continued to do well. So why has growth done well? Well, there's a lot of different reasons. There's interest rates being lowered, lots of reasons, but also just the fact that passive investing, many people think, is just continuing to reward things that do well year after year after year. So growth stocks keep growing as more money gets pushed into the market passively. growth continues to outperform. So why am I going through this? All of this stuff was exacerbated and accelerated in 2020. And we had a stat that we were looking at, and something like 95% of market returns since the low point in 2020 came from, we're talking US, came from 15 stocks in the index. So what does that mean? It means 485 stocks did nothing. We're essentially flat. And all of our return was coming from these giant companies. So whether it's Google, it's Facebook, it's all the companies that have benefited from the acceleration of some of these trends that were occurring. But they've also benefited just from pure passive investing and more money getting pushed into the market. So what does all of this mean as investors? It means that as passive investors, and we'll get to Australia in a second, as passive investors, we need to be very aware that when we invest passively, we are in a way making, I don't want to use the word bet, but I'll use bet. We're making a bet on a couple different things. We're making a bet that large cap stocks will continue to outperform. We're making bets that certain sectors like technology will continue to outperform. And we're making bets that growth investing will continue to outperform. And the reason we are is because the money that we're putting into an index is not equal. There's not an equal weighted index. So it's a market cap weighted index, meaning the biggest companies, which right now are large cap, obviously, those are the biggest companies, but technology companies that are growth stocks. So those are basically the bets that we are making as passive investors today. So it's just something to be aware of. And we have a good question saying, what should investors do if there's a rotation to value investing? Well, it depends, but let's go back and look at an era that some people are comparing this to, and that's the dot-com era. Same thing happened. They were slightly different companies, except for Microsoft is on the list both times, but increasingly large portions of the S&P 500 in the US were made up of large technology companies. There was increasing dominance in the top 10. There was also a period where growth outperformed value, because these tech stocks were doing well throughout the 90s. There are many people saying that this was a new economy, whatever Greenspan's words were on that, and that tech stocks would continue to outperform. So same thing's being said now, right? The value's dead, and a lot of value investors actually retired back in kind of the late 90s because they just weren't doing well and they just gave up. Well, what happened as soon as the dot-com bubble burst? Value started outperforming and significantly outperformed growth over 7 years. So if you think that that is going to happen, there's a couple things that you could do. So number one, you could obviously go out and actively invest. So find a value manager that will actively invest your money. The other thing you could do is you could, of course, purchase an index, a value index. So you can divide up the S&P 500 or any sort of global index in lots of different ways between value and growth stocks. You could certainly go into value, or you could simply buy an equal weighted index. So for the S&P 500 example, what are we talking about there? Well, instead of putting more money into larger capitalization stocks, so bigger companies, we are now putting an equal amount of money into all 500. So that'll sort of naturally, taper down the influence of some of these large cap growth stocks. So what does this mean for Australia? Well, Australia is different because Australia does not have these technology companies in general. So what makes up the majority of the ASX index? Well, it's exactly kind of what you'd think it would be. It's resources and it's banks. So I believe 45% of the ASX 200 is in the top 10 stocks. Those are, of course, dominated by the banks and the big resource companies, so whether it's BHP or Rio, and CSL is also on that list too. So it's just, once again, understanding what's in your portfolio so you can understand the risks you're taking. The one last thing I'd add about these three items, if you are picking individual stocks, think about what's going to happen when, and we talked about this effect of more and more people investing passively and just going in and making these one decision ETF or fund, these passive fund investments, which is just plowing more and more money into these large cap growth technology stocks. What happens when passive investors start selling? Well, same thing on the way down. So disproportionately, the largest shares in the index are going to get hit when people pull money out. Now, at some point, you would hope that active investors would go in when these companies start to show value, but that could be a big fall before that happens. So you're going to get impacted by all these passive outflows. Apple's a perfect example. So as I said, 6.7% of the S&P 500. We at Morningstar think Apple's 22% overvalued. So we don't think that value investors, people, once Apple got cheap, people would step in for a while. So just something to consider. All right, so let's go to some questions because questions are fun. All right, so we've got a question from Peter. So Peter says, do you review any reverse type stocks or ETFs? All right, so let's talk about what these are. So there are basically ETFs they're bear market ETFs. So basically what they do is their return is the inverse of the market return. So what that means is that if markets go up, they will go down. If markets go down, they will go up. And not only are there these ETFs that will move in the opposite direction as markets, but the same percentage. So market goes up 10%, they go down 10%. There are some that actually have leverage built into them. So they will go up or down at multiples of the market. So we do not review any of those. So our analysts don't cover those because we think they're pretty speculative, and rightly or wrongly, our decision is not to review things, including sector-specific ETFs, that we believe are speculative investments. So we do not review those, but that's certainly an opportunity. If you think the market is going to fall significantly, it'd be an opportunity where you could actually make money. So you can use that as a hedge. But yeah, something to think about. Okay, we've got a question saying examples. So I'm gonna find one first. Examples of value ETFs. So let me try to find some. So I'll share my screen as soon as I've found a good example. Let's see. Sorry, now it's just me mindlessly going through our website. Yeah, I will find one for you. So basically what a value ETF is an ETF that just takes the value component of the market. All right, I promise I'll find some, so we will get back to those. Actually, Shani, do you want to do me a favor and try to find a value ETF for me? Okay, so we'll move on to other questions, but we will get back to that. Okay, so we've got another question around value, saying, how do you determine what's a growth or a value stock? I want to invest in value stocks. How do I find them? Okay, so growth and value is very simply, so I know exactly how to find those ETFs. Growth and value is simply taking the overall market. So when we're talking about looking at indexes that are based on growth and value, is simply taking the overall market and then going and dividing that up by a number of different value measures. So there's different techniques that different people take. But basically ones with things like price earnings ratio, price to book value, price to cash flow, you're just dividing them up. So growth stocks are ones that have higher ones, and generally they have higher ones because they are expected to grow more by the market. So higher PEs, for example, and then value stocks have lower. So let's see if this works. This is my attempt to find some value ETFs easily. Not that I don't think you can do it, Johnny. Well, she's still looking. My attempt didn't. There we go. I found one. So I'll add a couple to my watch list so we can look at different ones. First, I'll show you guys what I actually did. All right, so what I did is I went into our filters and I looked at the equity style box. So basically the equity style box looks at where the shares that are within these ETFs, where they fall on I'm looking at value, but a value to growth spectrum. So I just highlighted these 3 boxes. So large cap, larger stocks, mid cap, small cap, and just hit apply. So what this is going to do is it's going to go through, and a lot of these make sense, it's going to go through and look at all these ETFs and where do the stocks that are held within them fall on this spectrum. So a lot of these make sense. So we look at this Beta Shares Australian Financial Sector ETF. So what does that mean? That means that these are just stocks that are within the financial services sector in Australia. Now, financial services stocks, bank stocks, are classic value stocks. So that's what it's picking up there. But then when I went on to the next page, you can see all these different sectors. So dividend stocks makes a lot of sense. Stocks with high dividends generally are value stocks. So you see dividends all throughout here. Consumer staples. So think of those as, consumer staples are goods that no matter what part of the market cycle in, people will buy them. So think about a Kohl's, Woolies, for example. You've got low volatility. So low volatility, this makes sense. Low volatility stocks are stocks that have lower betas, and that always corresponds with values. That's how much they're going to bounce around depending upon market movements. So what I did is I clicked on a couple that are pure value, and I added them to my watch list. So I add them to this ETF watch list. So you can see some of these things that I added. Vanguard Global Value Active ETF. So they're actively selecting value stocks that go into that one. Which was the other one I added? This VanEck Vectors International Value ETF. So those are both examples of pure value ETFs. So I did something. All right, let's keep going into questions. Are you sending me?
I sent them, you just didn't look at it. I did the exact same thing.
Okay, so Shawnee's saying she did the exact same thing as I did. So that's good. You sure I didn't just say them and then you just sent them on the chat? Okay. So let's keep going with questions. Okay, so we've got a good question from Ronald, who says, a useful guide for investors used to be the PE rating roughly around 14 to 30. Since the low point of the pandemic, the growth companies' PE ratings have soared to unheard of ratings. The market was to return to the traditional PE levels. There would be a bloodbath. So has the market now reached the stage where some companies are too high in share market value to fall? Okay, so let's talk about a couple different things. So one thing that happened during the pandemic. So yeah, agree with you. If you look at the market, Ronald, in almost any valuation technique, it is very overvalued. So that is absolutely true. But if we just look at price to earnings ratio, there was a distortion last year, and the distortion was that not only did prices go up since that sort of March fall, so the market anticipated a recovery of economies long before they actually happened. So we're obviously starting to see GDP growth. If we look at the US market, there was a huge, I don't even remember what wave it was, but it happened kind of around Thanksgiving. So stuff that happened in the fourth quarter in the US. So the US economy did not recover how people expected it to. Now, of course, they're expecting it to recover going forward. So what that meant is the market was way up and the earnings were way down. So I will say, Ronald, that we are at a probably artificial high right now because prices went up and earnings fell. So not only did the P go up, the E went down. We think that E, the earnings, will go back up to a more normalized level. But that does not mean that the market is somehow undervalued. It's still very overvalued. That's why we look at things like the CAPE ratio, so that's cyclically adjusted PE ratio, which smooths out because it looks at 10 years. It smooths out 10 years of earnings, it smooths out some of those earnings volatility that you can have. So yeah, the market is by, in every sense, overvalued. Does that mean it's going to fall immediately? No. I think we did a whole episode looking at Jeremy Grantham, who thinks it's going to fall very soon. So his prediction, and he's in the Northern Hemisphere, he's in Boston, but his prediction was late spring in the Northern Hemisphere, early summer. So think about us, that's a late autumn, obviously. Early winter, that's when he thinks it's going to fall. So yeah, I obviously cannot. I don't know the answer. So it's hard to obviously come up with an answer. But yeah, a lot of people I think are worried about valuation levels, and I think they're particularly worried about some of the signs of speculation that are creeping into the market. So whether that's it's everything we saw. We saw GameStop. We saw SPACs, which we covered on a podcast a couple weeks ago. The use of options by retail investors. There's just a lot of signs of a lot of speculation, and we're seeing it here in Australia as well, particularly around some of the small miners and companies like Afterpay and Zip, where there's a lot of speculation from retail investors. And yeah, we will see what happens. One thing, and this is not a unique opinion, but it's obviously a personal opinion. It's also looking at some of the new investors that are going into the market and what kind of stomach will they have for falls. So these are investors that are, we'll just call new to the market in the past 10 years, where the market hasn't gone down. So we obviously had that drop, that very short, sharp drop in February and March last year. But besides that, the market's been basically straight up since the GFC. So the question is, and especially with some of these passive investors, we're talking about the market starts falling. Is there going to be panic, which will of course just exasperate those falls? All right, so we've got a question from Nina on the Morningstar Tech ETF. Is it passive or active? Okay, so what this tech ETF is we, at Morningstar, we also have an index business where we sell indexes to ETF providers, for example, who then start an ETF off of that. So what this is based on, it's based on something called the Morningstar Developed Markets Technology Moat Focused Index. So what does that mean? Besides being, we name things terribly. I'm not sure if Shani actually named that, but what that basically means is we are taking developed markets. So it should be obvious, not emerging markets. We're taking developed markets. We're looking at technology companies that have moats. So it is not active in the sense that somebody is in there actively picking it. It is off of our analyst ratings, but it is an index that's designed around what our analysts think about these stocks. They are the ones that set moat ratings. So moat represents the sustainable competitive advantage of particular companies. So that is what that's based off of. And there are some rules in there around country and geography limits, which cause this thing to rebalance. All right, so we've got a question from Lisa. And Lisa, we were talking about you before this. We were worried about the alpacas, how the alpacas were going to do given the weather. So hopefully the alpacas are good. I'm not sure if they like rain, don't like rain. Lisa has alpacas. So she says the ASX is valued over the pre-GFC level of 6,600. How do we justify investing for nearly 15 years in this market? Is a reflection of actual stock values. Okay, so a couple different things. So Lisa is looking at where the ASX is before the GFC. So obviously, if you were to invest right before the GFC, not a great time as an investor to invest. It does sometimes take a very long time for markets to come back and hit those levels that they were at before a very large fall like the GFC. So how do we justify investing for nearly 15 years in this market? So yeah, I mean, I think the question is there, like, yeah, if you put all your money in right before a giant fall, that, yeah, it becomes difficult to invest. And maybe that's something to think about now. You know, when we're hitting all these valuation markers and we sort of repeatedly say, we have not seen this since before the GFC or before the dot-com bubble burst. Yeah, think about what happens if you are putting large sums of money into the market right now. So I guess I just say that, you know, valuations do matter, and valuations often reflect the valuation levels that you invest in, often reflect the returns you are going to get going forward. All right, we've got an update on the alpacas. They are very cold and they are shivering, despite their, you know, coats. They're high on a hill with a great view and plenty of feed. Okay, well, that's good. So the alpacas are safe. That is really good. All right, so we've got a question from Polly saying, current government financing of share markets could give false estimates of company valuations. Is it possible? Yeah, so what I would say is, I turn around your comment a little bit. What I would say is the desire of central banks to keep interest rates, I would say artificially low for an extended period of time is impacting valuation levels. So this, quickly, what this goes back into, a big input that goes into valuation levels is, of course, the discount rate. So when you're valuing a share, or valuing a company project or anything, what you're doing is you're estimating out cash flows into the future and you're discounting them back to the present day. So yes, low interest rates and what your view is on interest rates, they're at historic lows, is influencing valuations. It basically means that valuation levels, what investors are willing to pay for those future cash flows, is a lot higher than it would be in any other interest rate environment. So if we talk about things that could potentially break this market, higher interest rates or inflation starting to pick up are certainly things, because investors have priced in kind of the continuation of what's happening right now, low inflation, low interest rates. They price that well into the future. And we talked about, when we looked at a review of a couple different markets, we talked about this Nifty 50 market. So sort of the run up in equities during the 60s. And then literally when the market, quote unquote, broke in the early 70s, I think like late 72, 73, 74. Why did that happen? Well, one reason that happened is inflation took off, and interest rates went up as a result. That caused a big problem. People are worried that something similar could happen now. Obviously, once again, I can't predict the future. I don't know what's happening with interest rates. I don't know what's happening with inflation. I do know, of course, there are all these statements by the central banks that have made investors very comfortable with the current inflation or the current interest rate environment, because they basically said they're not raising rates for a couple of years, no matter what, even if inflation picks up. Now, any change in that, they wouldn't even have to raise interest rates. They would just have to change their posture and change their statements, I think would really spook markets. And we saw this back in sort of January, February, where we did see both in Australia and the US, we saw interest rates on 10-year government bonds go up and the market freaked out. And basically, technology stocks kind of cratered. And the reason for that is growth stocks. So we think about discounting back cash flows, future cash flows. Growth stocks, because they're supposed to grow faster, will get hit harder with interest rate increases because there's more future cash flows further out into the future. So when that discount rate goes up, so just mathematically speaking, when that discount rate goes up, those future cash flows are worth significantly less. So that could be something that also breaks this growth stock sort of hold on the market. But obviously, once again, I don't know what's happening with any of that. All right, so we've got a question from David. which I think is a good one. So another thing, do you think that the RBA might raise the cash rate to slow the rise in housing prices, or keep the cash rate low to stimulate the economy, or somewhere in between? Yeah, once again, I can't predict it, but let's talk about the different things that David is talking about. Anyone who's read the paper and looked at what's happening in housing prices in Australia after a little bit of a dip, after obviously a long-term continued climb, there's a little bit of a dip around around COVID, but they are growing extremely strongly right now. And if we think about inflation, like, what's a big part of inflation? Well, a big expense for everyone is housing prices. Now, it's been a little bit interesting. Personally, I rent. My rent came down pretty significantly. I have a lot of friends that rent. Their rents have come down significantly, but housing prices still continue to go up. So there is talk that at a certain point, the RBA is going to need to do something to try to control housing prices. And yeah, that could be a possible driver of raising rates. Now, the RBA has said that they are not raising rates for a couple of years. But I would say that anybody should, of course, be able to change their mind if conditions change. The other thing is, and your sort of second point, David, about keeping the cash rate low to stimulate the economy. Now, the question is, how strong of an economic rebound do we have? Now, we at Morningstar think that there will be a very strong economic rebound globally. So certainly here in Australia and in the US. And given all the stimulus that's happened, at Morningstar, we actually think that that rebound is going to be, that the economy is going to grow faster than we thought it would grow pre-pandemic, because of all this money that's getting pushed into the system. Now, if the economy is doing really well, and there are adverse effects from low interest rates, whether that's inflation, and inflation and housing prices can be the same thing, whether it's bubbles forming in housing. I would think that the central banks would sit there and have less of an excuse not to raise interest rates if the economy is doing really well. So yeah, it's an interesting one. I would say traditionally, if you look back, interest rates are a pretty blunt instrument and not as precise as some people would make them out to be. And I don't think it would be beyond the possibilities that the combination of low interest rates and then huge stimulus by governments, the U.S. just passed a $1.9 trillion package. I saw today, I got a notification from the New York Times on my phone saying that Biden's going to propose another $3 trillion of infrastructure spending. At a certain point, this stuff is going to work, and it might work really, really well, which would cause them to try to slow down the economy. So if you go out there and put $1.5 trillion into infrastructure in the U.S., not to mention all these direct checks that are being mailed to everybody and everything else, some of the same stuff we're seeing here where they're accelerating infrastructure spending, at a certain point, this stuff is going to work, and it might work too well. So that could be a catalyst to raise interest rates faster as well. All right, so we've got a question from our favorite attendee, which is the anonymous attendee. If bond yields keep rising despite the resolve of the Fed and the RBA to keep them down, would government agencies have to hike interest rates, force the markets to do so? Okay, yeah, so when we go back and we talk about what happened and what I alluded to earlier, sort of forgetting the time frame because everything's blurring together. But yeah, kind of late January, February, where we saw this rise in rates. So basically what we saw is both the 10-year rate here in Australia and also in the US on government debt. When we saw these rates go up, in Australia, they went up sort of late in a week. So it was like Wednesday, Thursday, Friday, I believe. And then the RBA intervened again pretty aggressively on Monday and went out there and started buying back bonds. So basically this quantitative easing that has happened off and on since the GFC, where literally central banks are just going out there and purchasing bonds, removing those bonds from basically circulation in many ways, holding them on their balance sheet. They're doing that to keep interest rates low. And central banks have been really aggressive about that since the GFC, and especially continued into COVID. So we're seeing these interventions. I think that I think the question is, and you say government agencies, so technically central banks are independent, but yeah, there could be a point when central banks decide that they're not going to intervene as aggressively in the market. If they even went back to what they were doing before the GFC, they were not doing all this quantitative easing. They were not going out there, and they were basically controlling interest rates with sort of their general open market activities, but they were not aggressively going into the market the way they are now. And I know I've said this a couple times, but during COVID, the Federal Reserve in the U.S. went so far as they bought bond ETFs, which many people think is illegal and outside of their charter. And the reason they were doing that is they were so worried about corporate debt. And they were so worried that if liquidity dried up in corporate debt, all these companies would go out of business because there's basically a huge drop in their revenue and demand because of the COVID restrictions. They were so worried about that they decided the most efficient way to do that was to go out there and buy ETFs. Because ETFs, of course, are baskets of bonds. So there's a lot of unprecedented stuff going on. It's worked pretty well, I will say that. I'm not trying to be the old curmudgeon about this, but it's worked pretty well. But think about all the stuff that's happened in central banks that literally they would never have done, that people thought was unthinkable. It started in the GFC, where the US Fed started buying mortgage-backed securities. They never bought mortgage-backed securities. They bought government bonds. Then, of course, they said they buy mortgage-backed securities, so securitized loans to support the housing market, and said, well, they're kind of guaranteed by what then the US government owned, Freddie Mac and Fannie Mae, so we can buy those as well. And there's been this slow creep. So yeah, I mean, I guess anonymous attendee, I don't exactly know. I don't know what would happen, but yeah, I think central banks at some point, if they sort of take their foot off the pedal, it seems like yields want to go higher. So yeah, that could potentially happen. Yeah, so I got a question from John saying, why can't retail banks increase interest rates outside of central banks? This would, of course, please John because he's holding cash in the bank. Okay, so yeah, I mean, listen, a bank can do whatever they want. The problem is, of course, that a lot of income from banks come in that sort of net interest margin that they're making. So the difference between how they source funds. And so they can source funds, of course, they can borrow it from things like central banks, and that's how central banks control interest rates in some ways. Or they, of course, source funds from people like you, John, that put money into the bank. So I'd say there's little incentive for them to raise interest rates, and frankly, they wouldn't do it unless they could raise rates on loans. So that's the only way they would probably do that, is if they could pass those on to customers that are borrowing money. And it's kind of one of those things where you're waiting for somebody to blink. Nobody can really do that unless all their competitors do it, because no one will get a loan from them. So it's just one of those things where in many ways they have to move in lockstep. And we've seen this before. We've seen a couple of years ago when rates were going down that some banks were not actually passing off those cheaper rates to customers. And there was this big, outrage about all of that. So yeah, I mean, I think it's probably pretty unlikely that anyone's going to do that. And John saying, isn't that cartel activity? Well, yeah, I mean, technically, right? So, we've seen this, we've seen this stuff before, but, unfortunately, and I don't remember the details around it, but there was one bank that didn't pass on these interest rate reductions to consumers, and another bank did. And yeah, I mean, it's cartel, or it's just a very competitive environment where people are all selling the exact same product. But yeah, I mean, if a bank raised interest rates, the interest rates that they were paying customers, of course, a flood of money would go in there, which would just raise their borrowing costs even more. So they'd have to pass it on. But yeah, cartel activity is a good way to describe that. All right, so we've hit with cartel activity. We have now hit 2 o'clock. So I won't make that joke. But anyway, thank you guys for joining. We'll talk about international investing on Thursday. I really appreciate all the questions. And Lisa, I will be thinking about the alpacas, and I think they're going to get better weather tomorrow and dry out their alpaca fur. Is that what you call it? Wool, probably. Okay, I'm going to learn more about alpacas, but thank you guys for joining.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.